Oh my gosh, I'm not Eric. No, we're using some software right now so we can do the picture in picture when I'm sharing my screen and going through the slideshow. You'll still be able to have the little blurb of me down over in the corner. So thanks everybody for joining us. It's another edition of Wealth Wednesday, starting here at noon every Wednesday. Today we're going to be talking about the difference between mutual funds and ETFs, exchange traded funds. I do have some of the comments up and over here on my side. So if you catch me kind of looking over, that's what I'm doing. I'm looking at the comments, seeing if there's any questions that come up. I hope everybody can hear me okay. If you're having issues with the sound or something, type it in, let me know. It looks like on my end we should be good to go. So what I'm going to do real quick is flip this so you'll be able to see my screen. It should just take a second if I can get it figured out here. And all right. And then I'm going to go like this, and I'm going to go like this, and go like this. Okay, and hopefully I will be waiting for just a quick second here. Hopefully it converts over and we can see my screen sharing. Let me know again if you guys can't hear me or if you're not seeing my screen or anything like that. Today, as I said, we're going to be talking about the difference between mutual funds and ETFs. And whenever we get into this discussion, this whole idea comes up about like pie charts and how we're invested and how we're I hope that's Morgan. She has to go down for a nap and she's not too happy about that right now. So everyone's dealing with this fun work from home stuff, right? But anyway, oh, actually, you know what? I got to go back because I just noticed that I made the mistake Eric told me I was going to make. I forgot to do the spotlight thing and get this back over here. So now it should be a little bit more full screen. You guys should be able to see this a little bit better. So again, when we get into the whole mutual fund versus ETFs thing, a lot of people think about investing in terms of complexity and about all these really complicated things and pie charts and how we're allocated and you know, how much exposure should I have to these different sectors, and there's a lot of jargon that comes into play and different things like that, and I think really in reality that wealth can be a lot simpler. And what we're going to go through in here is some information that I think is just super simple and yet has the potential to radically shift everything, even though it might be as simple as, you know, if you could get the same outcome, would you rather pay $1 for that outcome or $2 to get that outcome? Well, you'd rather pay $1 to get that outcome, right? Well, congratulations. You just made the fundamental decision in terms of wealth. That's all wealth is. That's all it has to be, is just a real simple thing. So let's dive in and get into the meat and potatoes of this. If you've seen some of our presentations before, you've probably seen this chart where we talk about the three largest expenses for a retiree are going to be number one, taxes, number two, investment fees, number three, healthcare. What's interesting about exchange traded funds is that they actually help you reduce both of the top two expenses. They help you reduce your taxes, which we'll talk a lot about on the back end of this video. And then they'll help you reduce your investment fees to a huge degree, which we'll actually kind of start with on the front end of the investment savings. So in fact, the order that we're going to go through things, we're going to, number one, talk about cost of ownership. Number two, we're going to talk about the structural differences, because mutual funds and ETFs are not apples and apples. It's completely apples and oranges. They're two totally different things. So don't get wrapped around like, oh, I can buy this growth fund or this growth ETF and I'm going to end up in the same spot. There's huge structural differences with how they work. And then finally, we're going to talk about how the average retiree is completely giving up control of their tax return when they buy a mutual fund. And that might seem like hyperbole, but when we get late in this webinar, you're going to see just how much the tax impact can be off of very small issues with mutual funds. And it'll probably be surprising, but we're going to start off with cost of ownership. So this is a chart. Hopefully it's coming through okay, but this is a chart that a client of mine, they owned a mutual fund, ANCFX. I don't know if you can make that out, but it's an American fund. I'll just throw that out there. And they showed me, based off of the fund's own website. So if you go out to the fund's website, they showed all their performance going back over the last 10 years, and they showed that they're outperforming the S&P 500. And the fund family made this big deal about American funds, about this one particular fund outperforming the S&P 500. And I started laughing when I saw this, because This is a little thing that actually is a big deal. So here the mutual fund is the blue and the S&P 500 is the orange. But the mutual fund company, very interestingly, they chose SPX as the benchmark. And what SPX is, it's the S&P 500 composite, which means we're just going to look at the price change of these 500 companies. We're not going to include any dividends they pay out. What happens if we include the dividends? You can probably take a guess. Well, what happens is this kind of brown or darker orange line that's up above, that's the performance of an ETF that tracks the S&P 500 that also includes the dividends. So what's really interesting here is instead of beating the benchmark by 20%, this mutual fund is actually 50% behind an ETF that's including the dividends. And a big part of this difference in performance is actually coming down to fees. So before we get into all this, by the way, I'm not telling you if you own a mutual fund, go sell it. Or if you don't own ETFs, put all your money in ETFs and get into the stock market. This isn't like a specific recommendation. We're just going to be comparing and contrasting the differences between mutual funds and ETFs. And some of these numbers are going to be surprising. So again, here, this is a simple matter of the mutual fund company kind of being fuzzy, fudging a little bit with what their benchmark really is and leaving out a huge source of the returns because they know if they used a real benchmark that included dividends, they'd be, in this example, 50% behind that benchmark over a 10-year period. So that's pretty wild. The biggest reason for this, so this is that actual fund. If you go out and look it up, it's a $107 billion fund. It's a huge fund. And the expense ratio, so again, there's some jargon there. Expense ratio might scare some people off, but all it means is what percentage of your investment in that fund is going to expenses for that fund each year. And in this example, it's 0.62% a year. So that seems low. Like when you hear it, 0.62%, that's pretty good. But when you look at what your options are, if I can get this to cooperate and go to the next slide, this particular mutual fund is what's called an active mutual fund. So they're over here on the left, and they're trying to beat the S&P 500. And what we generally see is those types of funds have very high expense ratios. So over here, we typically see a range of about 0.4 all the way up to about 1.1% a year. This fund being at 0.62% is actually kind of on the lower end of what we typically see. And then again, there could be an index mutual fund that's very similar in how it operates, something like maybe a Vanguard or something like that. And that fund is actually going to do much closer to what the benchmark's going to do. And they're going to charge a lot lower fees. So some of those index mutual funds might be in the like 0.1 to 0.2% range. And that's that second column there. But if we look at the same thing as an ETF, which just means exchange traded fund, and again, we'll get into what some of those structural differences are, but the fee there, you're talking anywhere from 0.05, maybe as high as 0.2. Most of the funds we use are in that 0.05 to 0.1% range. So right there, that's 0.5% a year. That adds up in a big way when you're talking about throwing away 0.5% a year just due to fees. But moving on a little bit, mutual funds don't have to disclose all of the fees inside the fund, which gets pretty interesting. So if you go buy a mutual fund, if I was going to summarize the biggest difference between a mutual fund and an ETF, if you go buy a mutual fund, you generally have to pay a load up front. You have to pay some kind of like setup charge. Those generally hover around 5.75%. Some are a little lower, some are a little higher. But then there's also things like deferred sales charges, 12B1s, a bunch of different other types of fees that go to the advisor. And then there's also transaction costs. So believe it or not, when the mutual fund is buying and selling stocks, they don't have to report the amount of money that they pay in commissions when they're buying and selling things. So that's actually not included in the expense ratio, which is really surprising to a lot of people. And then the next biggest difference between mutual funds and ETFs, besides for that front load, is something called cash drag, which is if you've been to our engineering retirement income presentation, you've seen us talk about cash drag. I'm going to get into it in a little bit more detail. It's actually kind of the whole next section of the presentation. But just know that as a general rule, mutual funds are more expensive than ETFs. There are occasionally mutual funds that are cheaper than ETFs, but kind of across the board, if you said, hey, Tony, what typically do you see? A mutual fund is anywhere in the neighborhood of 5 to 10 times the fee of a comparable ETF. And that's, again, not an exaggeration. I can show you a lot of examples of big funds being in that 0.5% ballpark, where very similar ETFs are at 0.05%. So let's talk about why, because that's obviously a very big difference in terms of how those funds work and how they pay fees. So we're going to talk a little bit about structural differences. I already showed you the top part of this screenshot where I showed the assets and the expense ratio. I didn't show you how that fund is actually invested. And what's interesting, when you look down at how it's invested, you'll notice that that bottom arrow there on the right is pointing at cash and cash equivalents of 5%. And that's pretty wild. So you're looking at a $107 billion fund, of which that would be what, about $6 billion that's just sitting in cash. And that's not just because of where the market is right now. That's, if you go back and look historically, a lot of mutual funds come out in that 5 to 8% range, which is 5 to 8% of your money that's just sitting there in cash. It's not doing anything. Why do they have that much sitting in cash? Okay, it's not to take advantage of market opportunities, as much as they might tell you that. What it's actually because of is something called redemptions. So the biggest difference between a mutual fund and an ETF structurally is this cash drag piece. And the reason they need to hold so much cash is if I go out and sell my mutual fund. So let's say that I own this fund, ANCFX, and I'm going to go ahead and sell it. If I do that, what happens is the mutual fund manager actually has to give me the money. So it's not a trade between me and another investor. It's a trade where the mutual fund company actually has to sell positions if they don't have enough cash, and they need to give me the cash so that I basically got out of that fund. When I buy into the mutual fund, I give them cash, and that mutual fund manager now gets to use my money to invest. So that's something called an open-ended mutual fund. Most mutual funds are open-ended mutual funds. And that sounds interesting, but it's actually really bad, because what it means is that's 5% of your money that is just never invested. Okay, that money's sitting there waiting on the off chance that 5% of the investors want to leave the fund that day. And guess when most people want to leave the fund? They want to leave the fund at the bottom when it's doing really poorly, when as a mutual fund investor, you should want them to be investing more money in so that manager can be buying more and more stuff. But instead, people are panicking, and now this manager is forced to sell stuff low and pay those people out so they can redeem their funds. With an ETF, none of this happens. An ETF is like a stock, in that if you go out and want to buy that ETF, you're buying it from somebody that owns the ETF. You're not buying it from the ETF company. You're buying it from a bill across the country that's selling out of that fund. So what's interesting about that is if we pull up a similar ETF, it's going to be like 0.005% cash. I mean, they are fully invested at all times. And what does that mean over the long haul? Well, think about this. If you have 100% of your money invested versus 95% of your money invested, how does that pan out over the long haul? Well, I actually ran a quick example here, and sorry, I know it's going to be a little bit blurry on here, but $500,000 growing at 10% for the next 20 years. So this would be if you were fully invested. $500,000 growing at 10% for 20 years is $3.36 million. That's what it ends up growing to. And again, this is just totally a hypothetical. This is not an estimate of the future or a forecast or anything like that. And then over on the right, what we have is instead of being fully invested, only 95% of your money is invested. So here we have $500,000 growing at 9.5% for 20 years. And look what happens. It only grows to 3.07 million. So in this example, this investor, if they really put in 500,000, had it fully invested for 20 years versus having 5% of it sit in cash and not doing anything, they would actually miss out on $292,000 in gains just from that money not being fully invested. So think about that. And when you really get into this, the higher the returns are in the market, the more expensive this fee is. Okay, so if the market really does do 10% in a given year, your cash drag cost was 0.5%. You could have gotten 10% if you were fully invested. Instead, you only get 9.5% because you were only 95% invested. So think about that. That's 0.5% in cash drag. When the fund only had 0.6 of expense ratio, you're paying almost as much. You're losing out almost as much due to the money not being invested as you are paying for the expenses in the fund. Okay, so that's kind of nuts right here. It's really, if you total those together between the fee you're actually paying of 0.6 and the cash drag, you're really more like 1.1% in total costs or expenses or drag. So That's not even the biggest problem that I have with mutual funds. So we've talked about the expense ratio. We've talked about that hidden fee and cash drag. Now we're going to talk about, in my opinion, the most dangerous piece of the mutual fund, and that's tax control. And I'm going to say this. When you own a mutual fund, you have surrendered control of your tax return to that mutual fund company. Okay, if it's in a brokerage account, if it's in a joint brokerage account, if it's in any kind of non-qualified account, you have surrendered control of your tax return to that mutual fund company. In an IRA and a Roth IRA, this stuff won't apply as much, but all the expense stuff we just discussed would still apply. So let's talk a little bit about tax control and why I get so crazy about this. So again, same mutual fund. We're not cherry picking stuff. This is that same $100+ billion fund. If you go down and look, and I know this is probably a little bit small on this screen, but like 4 rows down, you can see that they had a capital gains long-term distribution of $3. Okay, what does that mean? Well, let's back up a little bit. Mutual fund companies have the authority to distribute capital gains as they see fit. So what that means is anytime they want, they can force every investor in the fund to take a long-term capital gain or even a short-term capital gain. And generally they do this at the end of the year. So generally you'll see this come through in like November or December, where if it's a big up year, they'll distribute some capital gains. And in this example, just in 2019, this fund distributed $4.5, and that's on $61 share price. So they had capital gains distributions. I'm going to just do this real quick on my calculator. Should have had this prepared, but they had 7% in capital gains distribution. So meaning if you had $100,000 invested in this fund, you would have $7,000 in capital gains that you were not planning on having. Okay, what can that do to your tax return? Well, it can be pretty brutal. So we're going to go through an example here of something that a lot of people don't think about. How does a mutual fund tie in with healthcare? Well, you're going to see here, this is a huge tie-in. So this is an example couple. They had $67,000 of income. And by the way, I have the words very intentional there because it's true. We're very much targeting that exact level of income. At the end of the year, we want their modified adjusted gross income to be $67,000. We don't want it to be $68,000 or $69,000. We want it to be $67,000. They're married. They're both 60. The reason we want them to have $67,000 is in that scenario, they're going to get $1,308 a month in subsidies for their health insurance. So what does that mean? It means a plan from Together, which is a health insurance company. They're actually my health insurance company. Together, CCHP, that's just, I think like Children's Community Hospital, something like that. But that plan, Together Silver Plan, is $542 a month. Pretty reasonable, right? You have two 60-year-olds married, $67,000 of income, $542 a month. What happens if they own a mutual fund and that mutual fund kicks out a 3% capital gains distribution? So they have $100,000 invested in the fund. It kicks out a 3% distribution. That would be how much? $3,000? Well, now in this example, they're going to have $70,000 of income, $70,000 modified adjusted gross income. It still says very intentional, but I should have taken that off. So this is now an error, and we didn't want them to have $60,000 of income. But let's say they had a brokerage account that they were managing themselves that they didn't really tell us about. And then all of a sudden, boom, it gets a $3,000 capital gain that just gets distributed in December. Well, they're still married, still 60 years old, except guess what happens at $70,000? Now they have no subsidy. The Obamacare subsidies are gone, 100% gone. Okay, so now their same silver plan from the same company costs $1,850 a month. Okay, so what was that before? It goes from $542 a month to $1,850 a month. So while they received a $3,000 capital gain, they lost $15,696 due to their healthcare subsidies. Okay, so that's pretty wild. That's a 15. Again, I'm just doing my calculator here. That's a 500% loss. If someone offered you the opportunity and they said, hey, if you give me $3,000, I'll take $15,696 from you. Well, that obviously is not something you do. Yet when you own a mutual fund in a brokerage account or joint brokerage account, that's the exact risk you're taking. And to me, it just doesn't make a lot of sense, because with an ETF, you don't have this risk at all. With an ETF, you choose when you take the capital gains. You decide. You're the one in control. You're still going to have those capital gains, but you're going to have the option of when you take them, and you're going to have a lot more control of your tax return and have the ability to make much more of those gains be long-term capital gains and save you a bunch of money. So we're going to wrap this up here, talk a little bit about taxable account rules. If you have a taxable account, so if you have a joint brokerage account, joint tenants with rights of survivorship, any of those types of things, first off, I would suggest retitling it, possibly if you live in Wisconsin, to marital property. But that again, we're getting a little bit into specific advice there, so I'm gonna leave that off the table. Let's just say there's big tax benefits to be had by retitling those accounts potentially. So here's some of our rules when we look at taxable accounts. So if you came in and said, hey, Eric and Tony, we want you to take over our account, what do you recommend? If you own bonds or CDs in a taxable account, we're going to do everything we can do to get out of those. And the reason being, bonds and CDs, all the interest they generate is taxable. Okay. And it's not taxable as long-term capital gains. It's taxable as income. Okay. So if you have 100,000 in a CD that's getting 3%, first off, that's great, because, rates are right now, you're not going to get 3% on a CD, but that 100 grand is going to kick off 3 grand in interest income, which again, in that last example, if you're in the wrong spot, that can screw up your whole tax plan. It can screw up your health care. Once you're on Medicare, there's certain levels where if you're making above certain levels, it'll actually lead to higher premiums for your Medicare. So again, you don't want bonds or CDs in a brokerage account, period. You also don't want mutual funds, which is kind of something that this whole webinar is about, right? We don't want mutual funds because they can randomly distribute capital gains anytime they want. You also have the dividend income that's coming in as well. We really don't like to see high yield bonds in a taxable account. So if you have a joint brokerage account or even like an individual brokerage account, all the same thing, you do not want high yield bonds in there, because what you're saying is, I'm going to invest, say, 100 grand again in a high yield bond fund. Right now, that might be throwing off $5,000 or $6,000 in income, and again, it's interest income because it's a bond. So now you're taking $6,000, $7,000 worth of income. Plus, if it's a high yield bond mutual fund, not only are you taking this big giant income that's really tax efficient, but at the end of the year, they might also go boom and distribute a big capital gain. So no high yield bonds, no mutual funds, no CDs. You also, believe it or not, don't want high dividend stocks in a taxable account. So what we try to do is something called coordination. And all of that means is if you have a traditional IRA, brokerage account, and a Roth IRA, we're trying to have all your aggressive growth assets over in the Roth, because as that bucket grows, you don't pay any taxes on it. And then what we want is all of your real tax efficient stuff, like very low dividend yield companies and stuff like that. We want those in the taxable brokerage account, so we're keeping your taxes as low as possible. And then if you say, hey, I want to own some high yield bonds, I want to own some high dividend stocks, I want to own AT&T or something like that. That's great, but hold it in your traditional IRA, because it's not going to screw up your tax returns. And also those are kind of lower growth names. You want to have your high growth names over in Roth, where you don't pay taxes in the future. And then finally, in a taxable account, the ideal thing we'd like to do is ETFs and something called direct indexing. I'm not going to get into direct indexing today. That's probably a topic for a whole nother Wealth Wednesday, but you can actually get slightly more efficient if your account balance, if it makes sense, and you can not even have the ETF expense ratio. So the bottom line on this stuff is that expenses are more important than gains. And I know that a lot of people, that kind of knocks them back off their seat a little bit, but expenses are predictable. We can predict what your tax return is going to look like this year. We can't predict what the market's going to do. We actually know to the penny what your expenses are going to be in a fund. But again, we have no idea what the market's going to do this year. So rather than focusing on, I kind of tell this story and yeah, Eric, I must be on a pretty good delay. I'm just seeing your comment now about the $3,000 gain causes a 500% penalty. But yeah, that's that's pretty brutal. But anyway, yeah. So taxes, fees, and healthcare will be your largest expenses in retirement. Fees are completely under your control. Taxes can be managed, and they're relatively stable. I mean, we know in the future that in January 1st, 2026, taxes are going to go up for everybody. We just know that that's the case. But right now, you can be making moves to set yourself up so that after 2026, you're in much better shape. For example, you might want to be taking more in terms of gains and things like that right now than you are after 2026, because there's a pretty good chance your taxes are going to go up in the future, especially as things come online for you, like Social Security, required minimum distributions, and all the other things that go along with it. At the end of the day, saving expenses is about control, because we want you at the wheel. And you've heard this from us a million times. You don't need more money; you need a better plan. But you've heard it a million times from us because it's true. You really don't need more money; you need a better plan. And what I'll actually go back out to the program over here and cut off the screen sharing. So, let me go silence that real quick. I'll be right back. The beauty of being live, right? So, I just wanted to say real quick that so many people focus on things like gains. They focus on investment returns. They focus on, hey, I have $1 million in here. Instead of making 10% a year, I want to make 20% a year or something like that. And they're so focused on pressing down the gas pedal. They're so focused on growing their money faster and all those types of things. But in the meanwhile, they have their foot on the brake the whole time. They're paying high taxes, they're paying high fees, and they're just like forcing their engine to work so hard to try to get the gains higher, when all they really need to do is just lift that foot up off the brake, and everything's going to work so much more efficiently. And that's really where we like to focus. So this was hopefully everything I said makes sense. If you had any questions about any of this stuff, or if you're watching it on a replay and you didn't get the chance to jump in with a live question, feel free to comment on this, because we'll still see comments on this post for many weeks and months and years from now. We'll be able to still answer questions about this post. Just reminding you guys all again, you don't need more money. You need a better plan. Thanks so much for joining us on Wealth Wednesday, and I'll cut out a little bit early so we can get out of here before 12:30 and you can get on to lunch or whatever you're doing next. Thanks a lot for stopping by and watching, guys.